Right, today's top stories from Reuters, breaking views here in London. UBS finally releases a leaked report on closing its fixed income division and sacking 10,000 staff. But how much is all of this going to cost the bank, and how Deutsche Bank's three-year strategy now looks pondersome in comparison? Chris Hughes joins me. You like that? All right, let's start with UBS. Lots of numbers today. But there is one, according to you guys, there's one big number lacking here, and that is the actual losses when they start unwinding all their positions, etc., and get out of the fixed income business.
Yeah, I mean, look, it's hard to quantify. It's hard to put a number on. I mean, there's a small paragraph, but very significant paragraph in their restructuring statement where they describe what they're going to do with the fixed income business, and it talks about the long tail risks of the assets there. Now, you know, they do put some numbers on what they're doing. They have a restructuring charge which covers these job losses you're talking about, but you know, unwinding a colossal, you know, we're talking about hundreds of billions of dollars of assets in this trading portfolio. I mean, you're hostage to fortune. Yeah. I mean, look, if markets are favourable, it may be that somebody rocks up and says, you know what, Sergio Amotti, we'd like to buy a big chunk of that off you, and we'll pay the price that you've marked them down to.
Is that what the market's betting on? Because let's face it, this stock is up, 10-12% over the last couple of days. You're highlighting these potentially huge losses. Is the market not realising that? Is the market not getting the full picture?
The market is pleased about the decisive strategy, and in a sense, if you say we're going to exit businesses which aren't covering their cost of capital, are losing money, so I mean that's clearly a good thing to be applauded. But look, if you sort of tot it all up, you're saying that in a way you're saying, you know, you got $3 billion of cost to do that. You're adding on, you know, $5 billion to the market cap, and let's suppose, for example, that you've got, I don't know, say $10 billion of losses to come in unwinding this portfolio. I mean, are you really saying that new UBS is worth, you know, nearly $20 billion more than it was, you know, a few days ago? And like, it may be, you may get there, but I don't know if I'd really want to chase the shares much higher from here, given the uncertainty.
All right. Yeah. Deutsche Bank, on the other hand, I mean, these numbers look pretty good, but they do have this slow grind 3-year plan, and you guys are saying, why not just do a rights issue?
Well, look, the big issue is
that
Deutsche.
What you're saying?
Well, I do wonder, because it's been hanging over Deutsche for a while. You know, it's a question of their capital, and they've always resisted a straightforward capital raise. They've always preferred to do, you know, clever things, you know, a little restructuring here, you know, some clever, you know, financial engineering there, if you like, you know, and they do have a plan. They've got a deleveraging plan. You know, they're looking to organically rebuild their capital over 3 years. But you know, if UBS hadn't come out with this really radical strategy, you'd be looking at Deutsche today going, oh, well, look, you know, good markets, good quarter, yeah. We can see how this will work. You know, we'll probably sit this out for 3 years. But, you know, it's just, you know, the world is moving faster in a way than Deutsche was planning for, you know, a few months ago when it came out, this strategy. Look, investors may be patient, but it seems to me that if you have a succession of quarters like the quarter they've had, where they had a good trading result in fixed income, a good trading result in equities, then, you know, they'll probably get there faster. But frankly, the next, you know, 12 quarters are not all going to be like the one they've just enjoyed.
And just to finish up with, and on the back of this, I know Edward Hadas is looking at this, but and that is, all the other banks, the investment banks, are going to be picking up a lot of business from, or potential business from UBS. They're going to see the value in that. The shareholder, the UBS shareholder, is not.
Well, currently the UBS shareholder actually, in terms of shareholder value, is getting the benefit from this. But as you say, you know, I mean, there ought to be, in theory, some kind of, you know, subsidy towards UBS, because, you know, if UBS pulls out of trading, that's, you know, that's capacity that is released for everyone else, and, you know, UBS is kind of loosening the job market quite substantially. So when it comes to those tricky conversations about, you know, bonuses at the end of the year, you know, everyone is going to be thanking UBS for taking a little bit of heat out of the already cooling job market when it comes to those conversations. All
right, that's an Edward Hadas piece, which I think you'll find on the Breakingviews site shortly. That's it. Thanks to Chris. Coming up this afternoon, we'll take a look at what the change in Apple management says about corporate culture. I'm Axel Threlfall. This is Reuters.